So that's, a much more encouraging sign. Still a bit of caution, as I say, but it does start to look a little bit better.
Kia ora, and welcome to the New Zealand Property Market Podcast, brought to you by Cotality for the 16th of February 2026. I'm Head of Research, Nick Goodall, and today I'm joined, as per usual, by Chief Economist Kelvin Davidson. Kelvin, I hope you're surviving the wild weather at the moment, mate. It's certainly pretty crazy here in Wally and was overnight. Certainly a bit of tying things down and whatnot in the middle of the night last night and dealing with children waking up. But hey, we survived, and hopefully it's not going to continue for too long. But let's talk about some work stuff before we maybe catch up about other things about the weekend. We've got some interesting lending data to get into later, but I really want to get straight into things with a bit of an OCR and monetary policy statement preview. So maybe kick us off with a bit of a state of the economy, the things that the Reserve Bank will of course be considering, especially given we did get the New Zealand Activity Index data for December last week, and also net migration data, which is a pretty important one when it comes to those macroeconomic figures. So yeah, take it away, mate.
Yeah, I suppose when you look across some of the recent indicators, maybe the last week, it does tend to look a bit more positive. I think there's still reasons for caution. We had that rise in the unemployment rate a couple of weeks back, for example. So, there's still a wee bit of caution out there. Some other parts of the economy maybe lagging behind just a little bit. But yeah, the most recent data was actually pretty encouraging. So we had the New Zealand Activity Index from Stats New Zealand for December. It was a 1.8% increase in that 12 months to December. When you look across Q4 as a whole, the average increase was about 2.3%. So, across October, November, December, each result was actually pretty positive. Now, you can sort of do some fiddling behind the scenes and translate that into a quarterly GDP path for those official benchmark numbers. What that implies is about a 0.6% lift in GDP in the fourth quarter. So, pretty decent result. It would be a slowdown from what we had, barring revisions. It would be a slowdown from what we had in Q3, which was 1.1%, but 0.6%, still pretty solid, annualized pace, 2.5%ish, something like that. So not too bad. Now, it also fits with some other indicators or other predictions for Q4 numbers. The Reserve Bank in particular has that Kiwi GDP indicator. It's sitting at about 0.6%. So yeah, looks like we'll have a decent number for Q4 GDP, which will be out, I'm not sure when, about another month or something, I guess, kind of mid to late March. So yeah, I think you look at that number and you say, recovery's here. We've had, it looks like we'll have 2 quarters of GDP increase in a row. So that's, a much more encouraging sign. Still a bit of caution, as I say, but it does start to look a little bit better. And then, net migration turning around as well. So in the year to December, 12 months, adding it up over that 12-month period, rolling total, about 14,200, just short of that in terms of net migration into the country in that 12-month period. Still below the average is sort of 30,000, 31,000. So we're still a fair bit below that. But that 14,000 number is the highest we've had for, I think, about 11 months. So yeah, it does look like it's turning around a little bit. And a two-way thing as well. It looks like arrivals of non-citizens, or basically kind of new migrants to the country, that started to pick up, as well as at the same time New Zealand citizen departures seem to have just slowed a little bit as well. So it's that sort of double whammy thing. And I guess, you always tend to have new migrant arrivals. I suppose the thing that might give people a bit more encouragement is if we see those resident departures slowing down, because it's been that big theme for a while of young New Zealanders heading off overseas. So I guess encouraging, if that can continue, we can start to see those departures slowing down even more, as well as those arrivals coming in. And there's a fair bit of pretty good evidence suggesting that the relative labour market performance plays a role in this. If Australia, for example, is looking stronger in terms of its unemployment rate and jobs growth, you tend to see that the New Zealand net migration balance is pretty soft as everyone heads off over there, or migrants from other countries go to Australia instead of here. So just a bit of a hint that relative position is turning around a little bit, particularly not necessarily just yet, but forecasts of the New Zealand unemployment rate coming down, jobs growth picking up a little bit, but those relativities might shift, and so that would play into a slightly stronger net migration balance. So yeah, I don't think it's nothing sort of emphatic yet, but when you look at that NZAC, when you look at net migration just turning around a wee bit, it does start to look a little bit more positive. But there's also reasons for caution as well. There's for every sort of positive headline you see, there are also other ones saying people, still battling with the cost of living, those sorts of things. So a bit of balance, I think, is still important, but more encouraging numbers.
Yeah, I think that's a good way of putting it. I don't really have too much to add. I think you covered so much of it off there. And I think, yeah, it's all about improvement, right? As long as the economy is improving, as long as we're starting to see increased net migration, and I take your point that it's absolutely about, fewer New Zealanders leaving in particular. And I think there's been a few other stories and a bit more out there talking about, the grass isn't always greener in Australia in terms of, the cost of living over there is still quite high as well. Yes, probably still a stronger labour market at the moment, but that can't go on forever, and it won't be for every industry either. So for some people, it's not going to quite be as attractive. Housing in particular isn't exactly much cheaper over there. So, having to get a mortgage, might look very similar to what getting a mortgage over here might do. I'm sure many people have saw that the official cash rate lifted in Australia last week. So, they're already on that upward cycle because they've got a stronger economy, because they've seen strong growth in prices, because they've seen a lift in inflation. They're having to fight against that sooner rather than later. Whereas, we're not quite at that point here in New Zealand. So I think there are those differences that are worth paying attention to, and that will be having an influence, as you say, not just on fewer New Zealanders going there, but hey, if someone's looking to move to a different country and they're looking at Aussie or New Zealand or similar places, maybe New Zealand's starting to just squeak up on that growth of attractiveness off the back of an improving economy, even if it's a slowly improving economy. But also, I think you're right that, it's not like the numbers are storming away. We've had some data for January as well, which shows that still reason to be pretty cautious around that. Shouldn't disregard that labour market result. The little lift in unemployment rate, yes, I know there was some positivity there with more people actually working, but there's still a decent underemployment rate too. People still want more work. It's still affecting different people in different ways as well in terms of different age groups and different parts of society too. So I don't think it's all great, positive, perfect news, but certainly it's better than it otherwise could be. And you've got to be happy to see a positive figure, and that's what that. Let's go back to that, New Zealand Activity Index, the indication it likely has for GDP, and that, as you said, what do they call it, Kiwi GDP, the Reserve Bank's nowcast of where they see, all the data they've got today, where they think GDP would land, and it's a similar result. So, yeah, I think there's good reason to think that GDP result will be positive when it comes through. Not quite as strong as Q3, but that was a big make-up on Q2. So, there's always a bit of volatility here as well. So I think that has to lead us to more positive than, negative. More optimistic than pessimistic, but there's still all those reasons to just hold that, confidence down a little bit and be a little bit cautious with this. So then, what's it going to mean for Anna Bremen in her first monetary policy statement? But of course, it's a committee decision on Wednesday. I think we can pretty much lock in a hold, right? So as per usual, our eyes are going to turn straight to their forecasts, and our ears are going to be very dialed into the language, the communication style, some of the guidance on the future, not just, what the forecasts say, but maybe how the governor talks about the future as well. How she talks about what their expectations are, how they're reading things, or what are the uncertainties, how they read, global impacts as well. So, it's going to be an intriguing statement for that reason. Where do you sit now, given, your tracking, I suppose, of the Reserve Bank since the new governor's come in, how she might give a read of this? How much might their forecast change? Do you expect to see them, put an increase slated in there for this year? Or do you think they'll stay strong and know they want to have that message to market of lower interest rates for longer to provide that certainty to ensure the market doesn't start pricing in those interest rates rises sooner, which then starts to see mortgage rates rise? Where do you kind of sit now trying to predict Wednesday afternoon?
Yeah, I wouldn't be surprised if the actual numbers stay pretty much unchanged. I would say
Okay.
this is a monetary policy statement. You get the detailed forecasts. Now, they could change just simply because she's a new governor and kind of wants to make things look a bit different. I'm not sure, but yeah, the actual path for some of those key numbers that come in that spreadsheet: GDP, employment, house prices, CPI inflation, and the official cash rate itself. They project all of that. Yeah, I kind of wonder if that will stay pretty much the same. It's probably more of a gut feel than anything else, but I'll definitely be going straight to that spreadsheet to check it out. In particular, the OCR track, I really just want to see if that's changed and by how much, if it has changed, and in what direction. But yeah, so I do wonder if the numbers themselves might stay pretty much unchanged. And it's about, we'll all have to dig into the, written commentary and the press conference and just sort of go, oh, what word have they included? It'll be economists sort of arguing over, choice of words, what's in, what's out. But it could be that it's actually a subtle change in direction through the language rather than necessarily the numbers. I wonder if that's how it sort of comes out, but yeah, all to be revealed on Wednesday anyway. I mean, perhaps the bigger picture for people, just the casual observer following all of this is okay. You could we'll all get excited about what's in the spreadsheet and what's in the report, but what does it mean for mortgage rates? I guess the people who have, because we know that the next move whenever it happens. So this is what the question's about. We know the next move is going to be up. So all of this discussion and intrigue, I guess, is about, well, when will that happen? It's not so much a question of will the next move be up. It's about the timing. Um, and if that's true, which I think pretty much is, people in terms of their mortgage rates, this behaviour we've seen lately towards shifting out for longer fixed rates, taking more fixed rates and taking them for longer terms, seems to be a pretty wise move, given that we know the next shift in the OCR is likely to be up at some stage, barring anything can change, of course. But just at this point, it seems like that move will be upwards. So those people who have been taking longer term fixed rates have probably been making a fairly good move, I would have thought. So yeah, I mean, how do I summarise that? It's for me, it's look at the numbers. They may not change very much, but there's going to be a focus on the language and just an interest in having a new governor, what her style will be, these sorts of things. So yeah, it doesn't make it any less intriguing.
No, of course. And I think, yeah, for the official forecast, they, like I said, they probably won't change too much. The inputs haven't, been too wildly different to previous or three months ago when these were last updated. And they're done by, policy modeling teams, analytics teams within the bank as well. It's not like a new governor's going to come and change their model in 3 months' time. So I suppose the numbers will be pretty consistent, and there's certainly, and any change there, I suppose we can't exactly pin on the new governor, but it's more about, like I say, that communication style, the wording. Maybe it's a job where we get the old monetary policy statement, the new monetary policy statement, we whack them into Gemini and get it to evaluate the difference and see if there's a difference in tone and the way they speak about things. And as you said, actually maybe watching the conference itself, because that's where you get to hear directly from the governor herself rather than just reading somehow, someone else's read on it or what someone else has picked out of it. So yeah, I think they usually record an hour after the statement comes out. So that's probably 3 p.m. on Wednesday. Our plan is to record a podcast in response to this too. It'll probably be recorded prior to 3 p.m. Usually we have a quick look at those forecasts, have a decent read over the statement itself, and then try and record to get that out as soon as possible. That'll be the plan this time around too. But we'll just sort of see if there's anything truly different in there that might take a little bit more time to analyse. We might push that a bit later, but the plan will be to have that out Wednesday afternoon, sort of before 5 o'clock anyway. So keep an eye out for that one, and we'll give our initial thoughts on that. Kelvin, you touched on the terms people are choosing. Of course, last week we did get more Reserve Bank data, this time for the term chosen on new loans. So it is when someone takes out a new loan, the term they're choosing. Often we talk, of course, a lot in our updates about how long mortgages have got to go before they refix, which doesn't actually care how long they fix for. It's just about what they're running down and then what that rate might have been, or certainly the fact that most people are adjusting onto lower rates, and we've got so many people, of course, like 30% within 6 months. This is not that. This is literally the term people are choosing, and there was quite a big turnaround, wasn't there? Which again, it's probably not surprising given the tone of things towards the end of last year, and of course we had the Reserve Bank decision at the end of November, which will have influenced people's decisions in December. So yeah, do you want to take us back to that time, the mentality we were in, and then tell us about the results of the actual lending data as well, Calvin?
Yeah, so I mean, it is a couple of months ago now, isn't it? This is just another split of the Reserve Bank numbers. They put out various cuts of them and they release them in a staggered way. I think this is the last cut of December's numbers that we'll get. But yeah, so as you say, it covers so-called new loans. So it's when you're buying a house, when you're switching banks, and keep in mind that there was a whole wave of bank switching in December, as well as loan top-ups. So I guess equity withdrawal is another way of thinking of that. So it's those kind of so-called loan events. And yeah, obviously we had a monetary policy statement at the end of November. So we saw in November's data that 49% of new lending done in November was floating. I guess people just wanted, if they were settling a loan, they wanted to stay a bit flexible, just wait and see what happened at that official cash rate decision, and then, decide what to do after that. Well, we got that decision. It was a pretty clear signal of, look, we're done cutting. We might not be rising yet, but at least we're kind of done cutting. So then roll forward to December, and all those people who were, or the next batch of people coming through, I guess, said, "No, I'm not going to float. I'm going to fix for longer." So 49% floating in November fell to 22% in December. So really sharp fall away in that sort of share of lending on floating rates. Back to kind of, there's always loans going out on floating rates for whatever reason. So a much more normal number. 49 was, I think, a record high. We're back down to 22, which was back down to much more normal levels. On the flip side, only 19% fixed for at least a year in November. Roll forward to December, and that was up to 49. So it was pretty much a mirror image of each other. Everyone floated in November, everyone fixed for at least a year in December. So yeah, quite a stark turnaround. 2 and 3 year fixed rates were really popular in December, so that seems to be the term that people are shifting out to. Not so much going out to those 5 year loans. It's a big call, I guess, to fix for that long. But certainly popularity of that 2 and 3 year duration. So yeah, I guess it's as you'd expect as you get towards the bottom of a rate cycle. People have been riding that wave down. If they can get to the bottom of that rate cycle, pretty clear signal from the Reserve being that that's kind of where we are. No surprise, people start to fix a bit longer again, and think about trying to avoid that upside risk for market rates. So whenever that happens, as we've just talked about, it might not be straight away, but it's probably coming at some point. So yeah, not surprising to see people fixing for longer. I guess it's something I've been thinking about as a theme for this year. It's not necessarily, I don't think it necessarily sort of dramatically changes the housing market in either direction, sort of a personal finance thing. But yeah, definitely been a theme I've been kind of watching for is when does this shift longer start? And seems like we're probably there now, and you'd imagine that this remains in place for a while. So yeah, really interesting data. It's quite stark on a chart. And keep in mind that the December numbers, there's going to be a bit of, not volatility necessarily, but it was just a massive spike in activity. The banks switching, everyone was just churning loans. So I guess every cut of these numbers is going to have a wee bit of kind of extra jumpiness in it, I guess, if that's the way of putting it, because there was just so much churn going on. So things will probably settle down in the January numbers, but yeah, definitely that switch to fixing longer seems to be underway.
Yeah, like you say, maybe a bit of a unique month in terms of the scale, but I think the trend is quite clear in terms of that turnaround. Whether it exactly continues on that trend month on month, the future is another thing to be seen. But I think, yeah, you're right. It's a clear change in mentality. Again, not a surprise. Like you say, you've got to think back to that time, the timing of the decision, the fact the guidance was, look, this is probably the last cut. I think that was really clear last time around. It was given, that we would expect that it would stay lower for longer. So, you could have been forgiven for just taking a year, I say, and just go, yeah, in a year's time, they're not going to change that much. But yeah, definitely that switch to the longer one shows that people are even thinking further ahead than that. I had to look at the 2 and 3 year data as well, because yes, while that massive change to the 1 year plus was interesting, it was the 2 and 3 year that jumped out for me. The fact that November, 10% of people took 2 years. In December, it went to 22%. So a massive jump there. In November, only 3% of people took the 3 year rate, and that jumped to 11%. So, and I think, again, if you look back at those rates back then, right, we were always sort of saying anything under 5%, those 2 and 3 year rates were still sort of hovering around there about that time. And given that's a pretty decent rate for a long term rate, if you were sitting at 5% over a long period of time, I think, again, it makes sense people have done that. And I think the reason I find it quite interesting to work through this and talk through it is it just can provide confidence to those that are out there that are thinking about this, right? If they're considering these numbers, and maybe it's power in numbers, others are doing it, you feel a bit more comfortable and confident that you've got the power of the numbers that are doing the same thing, that are seeing the market the same way, and certainly being advised similarly through mortgage advisors and bankers who are helping these people make these decisions and having those conversations themselves, who are actually, financially qualified to have those conversations and help people to make the decision that works for them, given their personal circumstances and what matters for them, whether it is the certainty or it's trying to eke out every percent or whatever it might be. then they can help them to arrive at a decision that works for them as well. So, I think the number of people doing that obviously just shows that for many people, they know that it's pretty low, and even if you didn't quite get the bottom, you're going to get a decent rate for a long period of time when we're likely to go into a situation where interest rates do start to lift over the next year or two, certainly, and that'll flow through to higher interest rates, which might, I don't know, maybe they're going to get to averaging 5.5 to 6 over the next wee while, which means anything around that 5 looks pretty decent. So still plenty to wait and see. Again, these rates I'm sure will change, and the decisions from people will change off the back of Wednesday's decision and forecasts. So it'd be very interesting to see the market reaction from the statement on Wednesday, and then of course how people read that and decide that to change their mortgages off the back of that. But always an interesting one. Okay, Kelvin. Then the other release I want to talk about pretty briefly, I think, today, because we can leave a link to the full report. People will take different things out of this. Plus, it got decent media coverage, so I'd be surprised if many of our listeners haven't already got the gist of this one. But it is, of course, our Pain and Gain report. This one was for Q4, of course, last year. So people that were selling a property in Q4, just looking at the difference in the sale price to sale price over that period of time. Yes, gross. Not taking into account any other costs. No, nothing if you've improved the property, nothing else, right? It's literally just sale price to sale price as a measure of market health, I'd say. And we're just looking at proportion of people that make a profit compared to those that make a loss over those two sale prices. As per usual, hold period is a big part of that. So I'll let you talk through that one. For me, that whole period was really interesting this time around because it got to a really high level. But I don't know if you want to talk about any highlights from the report itself. I'll leave a link to the report. Any key conversations or anything that jumped out to you, Matt, that's worth talking about. But otherwise, people go check it out yourself.
Yeah, I mean, it was all fairly stable. We had about 88% of resales made for a gross profit, or on the flip side, 12% made for a loss. The size of those gains and losses as well was fairly stable. Not really. I mean, there's always regional differences. I'm not sure anything really jumped out at me there. It was all fairly consistent across the regions as well. Owner types pretty similar, whether it's investors versus owner occupiers. The apartment numbers always weaker than standalone houses, but there's not really any signs that apartments are collapsing either. I mean, our HVI, home value index, looks a wee bit softer for apartments than other property types, but there's not necessarily any signs that people are abandoning apartments either. And they do make less capital gain over time. So in any market, there's always going to be a slightly greater chance that an apartment will sell for a loss simply because capital gains haven't accumulated as much as maybe other property types. So all of that's fairly stable. I guess hold period's the biggie. Yep, we say it every time, but the median hold period for resale profits in Q4 was ticked above 10 years, which we haven't seen before, and the median hold period for losses was just a touch below 4 years. So big difference there. If you've held for 10 years, think about what's happened over that period. Yes, we've had a soft period lately, but over a 10-year horizon, you're very likely to be up in terms of your property value. If you've only held for 4 years, tough. I mean, think what's happened. If you think from 4 years back 4 years ago, you're looking at early 22, late 21. That was the exact peak of the market. So it's been a tough period had to buy and sell so soon again afterwards. So the whole period is the big distinction here. 10 years versus 4 years, that's going to play a big role. So I mean, what happens from here on? Well, remains to be seen. But I guess some signs of slightly stronger conditions. Maybe house prices do start to lift a little bit, although there's not really much evidence of that just yet. You'd think that sellers would do a little bit better in the next little while, and buyers might have to fork out a little bit more. But I don't necessarily see things changing around dramatically. There's still enough restraints out there that it could stay a buyer's market for a bit yet. So I don't know, bit more pain, bit less gain for resellers.
Yeah, I think it'll take a little bit longer for that to truly turn around, right? Just with this value sideways, even once they see a bit of growth, I think you're not going to see too much change in these types of numbers. But we'll wait and see how that one plays out. I just think that on that longer hold period, I think it's really interesting, right? It's something we've talked about for a long time, that we haven't seen these people move houses either. And so for people that are re-engaging in the market and own a house and are selling that to buy another one, we've seen them be less active in the market over a decent period now. And we've talked about that and the implications from the economy slowing down, not being strong, and movers or prospective movers holding back, maybe coming back at some stage in the future. I think that whole period just shows that once again, right? That those people that are moving house over a long period of time and likely to still profit, based on those two sale prices, has just been lengthening out. So I think it's just yet another measure of that part of the market that just hasn't moved as much, right? That, what do you want to call it, middle to upper part of the market, people upgrading their house, maybe moving into better school zones or whatever it might be. That has just not been as strong an activity, and so that's lengthened out how long people stay in that house, and that comes through on this data too. So yeah, we'll talk more about our buy classification data for January next week when we release the chart pack this week, and buy classification will be on that. So we'll leave that one for more detail in next week's podcast, along with an OCR very brief review, because we'll talk about that on Wednesday more so anyway. But yeah, I think that mover group's obviously very interesting, and we'll talk about that next week. But that's pretty much it for the major updates, Calvin. There's a few other things on my mind. I just wanted to give a shout out for the fact that we're now releasing the full video of the podcast, as well as the audio on Spotify and Apple Podcasts and wherever you get your audio from. Spotify has the video as well. And we're also got a YouTube channel as well. So it's part of the Cotality NZ YouTube channel, but there's a separate podcast section for this one. So that'll be there every week as well. So yeah, look, feel free to let us know. I don't know who generally goes and watches podcasts rather than listens to them, but keen to hear if that's you, and what you think of the video version. But that's probably just a quick update on that one. In terms of other things on my mind, look, had a great trip to Auckland end of last week. Heaps of client, potential supplier meetings as well. So just good to, I suppose, go out there and have a chat to people and how their year's kicking off. I think, interestingly, AI was a pretty dominant conversation throughout. How are people using it? Which are they using? How do you measure use? How do you encourage use? So yeah, that was a really interesting one from my perspective, especially because I've been trying to use it as much as possible as well. So you're always keen to have those conversations, and I'm sure it's going to be one that just speeds up as we move through this year. And the main reason I was up in Auckland actually was for the New Zealand Green Building Council's 20th birthday event on Thursday night, which was great. Busy event. Wide range of people, some good yarns had, and met a couple of podcast listeners too, which is always nice to have. Someone come up to me and say they listen to the podcast. So shout out to the few people I talked to that did that as well. But that's kind of all on my mind. Is there anything else from a market perspective or work last week or this week that's on your mind, Calvin, before we quickly catch up about, in fact, my roof is still on my house, and the TV's still got sport blaring?
Yeah, no, not a lot, not a lot. We'll have our chart pack out this week, so good summary of everything that's gone over the past month, including buy classification. So I've got a few charts of that, as well as prices and sales and all of that sort of thing. But yeah, that's probably the main thing. Yeah, we're kind of vaguely dodging the weather. It's pretty heavy rain out there for us at the moment, but we haven't had the wind, and the weekend was actually pretty decent. We got my daughter's cricket on Saturday mornings, nice calm sunny morning, so that was good. And yeah, not a lot else to report. Sewing lessons, normal stuff. The level of sport to follow is just kind of just going exponential. So I don't really know how to keep track of all of that. But no, it's good. It's good. Busy week ahead, and yeah, feeling positive.
Yeah, Super Rugby's of course back, and I'm not sure if I've mentioned on here, but we I did get a hurricane season pass. They had a free. If you buy an adult, you get a free kids one. So pretty decent value there. So I think we'll head along on Friday night to the Canes' first game. Of course, they had a buy on the first weekend, but some great games. Those New Zealand ones, great in terms of being tight, I suppose. They weren't exactly entertainment spectacles, um, but probably good results from my perspective as well. I always, as many people know, happy to see the Crusaders lose, and Plymouth Islanders. So that was a tasty little result. And while the other game, the Chiefs and Blues, I'm much more neutral, I suppose. I probably do side with the Chiefs a little bit more. So yeah, that was a decent result for me too. Not that my tipping reflects that, and that tipping comps I'm in. And if we look at the cricket, yeah, disappointed to see the Black Caps lose, but it doesn't affect the next stage, those Super 8. So maybe it doesn't matter. Maybe we're foxing and don't mind losing the South Africans as long as we beat them in a knockout cup game or something like that, like we did many a year ago. But yeah, those are sort of my big sporting minds. Unfortunately, the women Phoenix lost yesterday, but they still right up there at the top of the table, so that's okay. And yeah, from a family perspective, we did have the X race on Saturday, which is a sort of fun race you do with your kids. So I paired up with the youngest two, and my wife did the oldest, and you run around doing challenges at certain stations and things. So good bit of fun, well-run event, sponsored by NZHL actually. So still within the industry. But yeah, good bit of fun and good to get the kids out there. And yep, like I say, kids swimming and whatnot. So yeah, look, it feels all go. Weather's gone to crap now, but it is supposed to improve this week. So yeah, fingers crossed we get that as well. But that's all that's on my mind, mate. Anything else to say before we get on out of here?
No, no, we'll crack into it. Busy week ahead.
No, I like it. All right, mate. Well, thanks as per usual for your thoughts. Looking forward to Wednesday, and we'll round up the OCR as well. Good to get your thoughts in advance of that. But just want to say thanks very much for listening. Please do get in touch with any questions or feedback. Let us know if you are one of those video listeners. Keen to hear about that. But otherwise, just want to say thanks once again. My name is Nick. He's Kelvin. You've been listening to the New Zealand Property Market Podcast. Mā te wā.